Transparency is one of our core values at Sweater. So when it comes to our fee structure, we want to make sure that you understand exactly how our fees work and how Sweater compares to other venture capital firms.
Fees in venture funds are very different from exchange-traded funds or robo-advisors. Venture investing requires far more labor-intensive practices to deploy the capital. This requires higher potential return profiles as well, which is why it's important to have professional management.
Let's first look at how traditional venture capital firms make money. This structure is commonly called a 2 and 20, referring to a 2% management fee and a 20% carried interest, commonly called carry.
Traditional VC firms charge a 2% management fee on the original committed capital every year for the first 5 years of the fund. The firm uses these proceeds to pay staff, manage deals, and conduct due diligence for the fund. As the fund matures over the last 5 to 7 years, that management fee gradually reduces.
The 20% carry is applied to the returns made on the investments at the end of the fund's life cycle. That carry goes to the professionals managing the fund. As a simple example, if a VC fund initially raised $100 million from investors and turned that into $300 million in matured venture investments, the firm would take 20% of the $200 million in gains, or $40 million, as the carried interest fee. This carry is what incentivizes traditional VC firms to perform, because that's how they make their money.
With that in mind, the Sweater Cashmere Fund operates under a different fee structure because it's a registered investment company. The Sweater Cashmere Fund applies a 2.5% annual management fee to the total value of the fund and does not take carried interest. In contrast to a traditional VC fund, whose 2% management fee is tied to the original committed capital, the Cashmere Fund applies its 2.5% management fee to the growing value of the fund expressed as the net asset value, and it does not take any carried interest on the gains.
The Cashmere Fund's incentive is aligned with the members of the fund to increase the value of the fund over time. This reflects itself as our deal team is drawn to making the best investments possible to increase the value of the fund. In addition to the management fee, the Cashmere Fund incurs expenses associated with fund operations, such as fund administration, legal costs, insurance, annual audits, and marketing. There are consumer protections in place as well for members of the fund that cap all fees associated with the fund at a combined 5.9% annually. You can review the complete fee structure in the prospectus provided in the app. Sweater is competing in the venture capital industry to find and invest in world-changing companies. This fee structure provides the infrastructure required to represent our members and maximize potential returns.
If you still have outstanding questions about the Sweater fee structure, we invite you to reach out to our member experience team for a complete discussion.